Hi, I am Pawan Madhogarhia. I'm an associate professor of finance at York College of Pennsylvania. I'm also the director for NASDAQ Trading Lab, and I'm also the advisor for the student managed fund. At Graham School of Business, we strive for our students to have experiences. We aim for those experiences to be both innovative and high impact. We have a state-of-the-art trading lab equipped with software such as Morningstar and Bloomberg. Students visited the NASDAQ Stock Exchange and were able to participate in the closing bell ceremony. I have been the academic advisor for the student managed fund for a number of years. This organization offers students ways to put the skills learned in different classes to use through fund management, financial analysis, planning events, fundraisers, and managing budgets. Currently, students manage real portfolio valued at $400,000 US. Most people want to make money and keep accumulating more. You could make money in a casino, depends on how lucky you are on a particular day. You could keep buying lottery tickets, and one day you could win a jackpot. You could invest in real estate and wait a long time for the real estate to appreciate in value. Or you could pick the right stocks and college could be free. Compounding is considered as the eighth wonder of the world. An annual investment of $10,000 every year, growing at 10% per year, will accumulate wealth of approximately $1.65 million in 30 years. The same investment growing at 18% per year will give you approximately $8 million, a little less than $8 million. Let's see how you can generate more than 10% return per year. The average annual return for the Dow Jones index is a little over 10% over the last 30 years. The S&P 500 index had about 10.93% return over the same time frame. Similarly, NASDAQ had a little higher, about 12.1% return over the same time frame. You could passively invest in these index funds and wait for your wealth to grow over long time periods. Consistently generating returns higher than the market is the difficult part. Only a few legendary investors like Warren Buffett have been able to do just that. How do you pick stocks? Well, investors typically look at different multiples such as price to earnings, price to book, price to sales, EV to EBITDA, etc. This may be the starting point to assess growth expectations for a firm. However, these ratios may not give the full picture. Another approach is to discount the future cash flows at the appropriate discount rate. This is a fundamental approach to value stocks. Now, this may be more appropriate for relatively stable stocks. If investors are highly optimistic about the expectations of a company, those stocks could trade at very high multiples, that is very high price to book, price to earnings, price to sales, etc. For example, Tesla, Zoom, and other companies. Corporations that have a high subscriber base and are expected to grow fast, if they can monetize their assets, they can command high multiples and trade at high prices, for example, Netflix. If demand for a stock exceeds supply by a wide margin, that stock could multiply in value quickly. For example, GameStop had short interest of more than 100%, meaning that more stocks were sold than were available for trading. And how did they do that? They borrowed it from the brokers. A lot of hedge funds were engaged in this. However, a few investors on Reddit.com, they collectively gathered support of other investors and convinced other investors that the stock was undervalued, and some good news came out, and the shorts had to cover their position, demand increased supply, and so the stock had a good rally. The stock went up from $3 during the troughs of the pandemic to a high of $480 within a span of several months. Stocks that have really high short interest may be the target for huge rallies on good news. Now, traders have short-term horizon to book profits. You could use technical analysis to figure out entry and exit points. If you want to make money in stock trading, you could buy low and sell high, also called value strategy, or you could buy high and sell higher, momentum strategy. You have to figure out what type of investor you are. Are you a value investor or a momentum investor? As Warren Buffett once said, be greedy when others are fearful and be fearful when others are greedy. So that's like a contrarian approach. Investors, on the other hand, have long horizon to accumulate wealth. If a company's earnings are growing at a fast pace, that should eventually translate into high stock prices. For example, the Apples and the Microsofts. Trailing price to earnings is backward looking. You may want to look at forward price to earnings, which provides you better indication of how much value investors are attributing to future earnings. If you want to rely on dividends for income, high dividend paying stocks may be a good bet. However, these companies may not have good opportunities to reinvest in their business, and hence you should not expect too much of a price increase from these stocks, generally speaking. However, you may want to watch out for spikes in dividend yields, which may be a sign of trouble for the company. Return on invested capital, that's another metric which gives you a sense of how well a company is using its cash to generate returns. The higher a company's ROIC, the less cash flow it needs to reinvest to achieve a given level of growth. Higher ROIC should translate into higher free cash flows and hence higher stock prices. So I ran a backtesting model in Bloomberg where I took the smallest 120 stocks that were part of the S&P 500 index and which had ROIC greater than the average ROIC for the whole index. So I ran this over a 25-year period ending in 2017, and the strategy would have multiplied the investment 25 times compared to the index, which would have multiplied only 8 times over this 25-year period. How much investment return you can generate depends on the price at which you buy an asset, the price at which you buy a stock, and the price at which you sell at. The rest is noise. If you bought GameStop at $5 and sold it at $4.50, you multiplied your investment 90 times. Instead, if you sold it at 45, you multiplied it only 9 times. If, I'm saying just in case, if it goes back to 5, then you only had paper returns. Best opportunities arise during bear markets in distressed industries. Financials were beaten down like anything during the financial crisis. Similarly, hospitality and travel stocks, brick and mortar retailers were beaten down like anything during the pandemic. Those who bought at the lows made good returns. However, some of these distressed stocks may be headed to zero. So one needs to avoid the value trap. So this is my recommendation. Hold 20% or more in cash for opportunities. Opportunities do arise. However, if you wait too long, opportunities may slip away. So you have to time your investments such that you can generate good returns for yourself. Thank you so much. I'm ready for questions.